Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this conversation on private markets. I'm delighted to be joined by the Managing Director, Franklin Templeton, Australia, Felicity Walsh, and the partner at Lexington Partners, John Lee. Thank you very much for joining us.
Thank you.
Thanks, Laurence.
Felicity, if I could start with the focus of alternatives for Franklin Templeton, what does that mean for the wealth market here in Australia?
Let me perhaps just take us back a step and think about Franklin Templeton more broadly. So Franklin Templeton today is around a $2 trillion Aussie company. Around 400 billion of that is now in alternative investments. So that's split across our private equity secondaries and co-investment team. So that's managed by John and the Lexington team. Our private debt businesses out of the US and Europe, so with Benefit Street Partners and Alcentra. Our hedge fund business with K2 Advisors, and our real estate business with Clarion. Amongst that entire $2 trillion, a large component of it is in alternatives. That demonstrates the slight obsession we have at Franklin Templeton with ensuring that alternatives are accessible by all aspects of the market. So traditionally, we saw alternatives being heavily used by institutional investors for many, many years. Here in Australia, we have been working with institutional investors to build out their alternatives programs for around 15 years or so. So that's been on the liquid alternative side, as well as the private market side. As we've kind of evolved and really got that confidence from the investors that we've brought to them solutions and capabilities that are really, really world-class and suitable for those really large institutional investors, we've had to think about ways of how we can actually combine the other expertises of Franklin Templeton, which is our enormous footprint within the wealth space. So if we look at the Australian market, we have around $15 billion under management here with wealth and retail clients. And those investors have seen what access the institutional investors have to these alternatives. And of course, naturally, want to have kind of similar access so that they can broaden out, diversify their own portfolios. So I think what's been really neat is the journey that we've been on to get to this point. We're now at a point where we're able to locally structure strategies, capabilities in a manner that suits those investors. Of course, they're thinking from an individual client perspective rather than a group of clients. So of course, they have different requirements, but they're still looking for access to those really world-class capabilities. So with Lexington as a great example, we're able to offer the secondaries capabilities in a format that suits our wealth investors, a little bit more liquidity, a little bit easier accessibility than perhaps our institutional investors need. So it's really pulling together our fantastic capabilities, our depth of relationships across the broad market. So we've been in Australia now for close to 40 years, so we've built up a fantastic client base. And we really want to just ensure that we're sharing those capabilities with all our investors. We expect to see more growth. We expect to see us bringing more of these capabilities that we've been working with institutional investors to the market in the coming years. So yeah, expect to hear a lot more from us on this front.
Could you address the Franklin Templeton relationship with Lexington Partners and why you think it's important for the Australian market?
Yeah, absolutely, Laurence. So in April 2022, Franklin Templeton closed the deal to acquire Lexington Partners. Lexington were an absolute world-renowned private equity secondaries and co-investment business. The bulk of their investors were institutional investors. I think it's fair to say that they have the who's who of institutional investors globally. So as we were looking to broaden our footprint, we obviously wanted really world-class investment capability, and that was demonstrated right off the bat from Lexington. At the time of the purchase, they were actually fundraising for their flagship Fund 10, and that was going phenomenally well. I think just the demonstration that they were at Fund 10 in a market that is relatively new just demonstrated the strength of the capability within the team. And I think it's fair to say Franklin Templeton have been through a few acquisitions. That's been very much part of our strategic focus, is to acquire where we don't have capabilities in certain asset classes or certain geographies, for example. And when we were looking at Lexington, I think one thing we've learned is culture is extremely important. So thinking about how will this group really fit within the Franklin Templeton world. And I think there were some really obvious synergies for the business when they were looking at Lexington, and in particular, the extremely long tenure of the partners within the business. So the partners have worked together for 18, 19 years consistently. That's the kind of length of tenure that Lexington have within their partners. So thinking about Franklin Templeton as a business and the family ownership. So as a reminder, Jenny Johnson is third generation Johnson. So her grandfather founded Franklin Templeton back in the late 40s. So that alignment of a very long-term mindset, looking after your team, employees, thinking about your business from a longer-term perspective, I think that kind of fitted really well for the two businesses. And I think also for Lexington, thinking about it from the other side, is that what did Franklin Templeton have that would really benefit Lexington? They had this huge institutional footprint, fantastic investment capabilities. They didn't need much help on that side, but looking at other parts of the market, so Franklin have obviously got an enormous footprint with wealth advisors globally and with the retail market. So how do those two come together, and seeing some of the enhancements that we've seen around structuring of strategies and the ability to bring a broader range of strategies to some of those markets, it was a really natural fit. I think the strength of that partnership was really demonstrated pretty soon after we launched our first evergreen vehicle with Lexington. So our strategy that we launched in the US at the back end of last year, Q4 2024. And we then followed up in Q1 2025 with a European and Asia launch. And we have raised close to 4 billion Aussie dollars in that strategy now. And it's been the fastest growing private equities secondaries evergreen strategy ever to launch globally. So I think it certainly felt to Franklin as a really neat two-way marriage.
So John, could you give us a little insight into Lexington Partners and the relationship that you have with Franklin Templeton?
Let's start with Lexington Partners. So we were technically founded in 1994. So we've been around for more than 30 years. But our roots actually go back to the late 80s, because our founder was one of the founding members of one of the first secondary, actually a pioneer of the secondary industry. So if you look at our track record, it actually goes past 1994 to the first 1990 fund. So we are the pioneers of this industry in the late 80s, and we are one of the largest players in the market. And so we're the oldest and the largest player in the market. I think that's the first thing to remember. The second thing is a lot of our competitors, who we have a lot of respect towards, some of them started off with a primary fund of funds background, and they had to expand into secondaries as they diversify their business. As a primary fund of fund business is shrinking, if you look at the long-term trajectory. We've always started as a secondary manager, and 35 years later, we're still a secondary specialist. I think the biggest evidence of that is the fact that our president, our CEO, is a secondary investment professional. He's an IC member. He's a chair of our IC. So we are very unique in that way. Not only are we a pioneer and the largest player, but we're also, everything in the firm, the 200 employees that we have at Lexington are really focused on our main strategy, secondary strategy. We're also differentiated versus other firms where secondaries is a business that they acquired across different buyout and infrastructure and real estate, and it's just one of many different business lines that they have. Whereas for Lexington, this is really the only thing that we do. So we joke that we live and die by secondaries, and I think that's a very big difference. In terms of our relationship with Franklin, we couldn't be more happy with the relationship with Franklin. I think the most important thing, and this is something that I personally tell my team when we're trying to hire somebody junior, number one is fit, number two is fit, number three is fit. So the cultural fit is so important for an organization, and we've seen instances where one or two bad apples really wreak havoc in terms of the chemistry of the team. So we're very thankful. I mean, it's been over 3 years since the deal closed in April 2022, and I personally have had interactions with a couple of dozen Franklin people, obviously in Australia, in Japan, Singapore, Hong Kong, what have you. And there really is a very good cultural fit. Culture is something that's very difficult to explain in words, but if you talk to anyone at Lexington, they would agree with that. And what's great about this partnership also is that while Franklin has been guaranteeing our independence, so we have been able to manage our firm the same way we have been managing over the last 30 years. Nobody at Franklin is sitting on our IC telling us to make different investment decisions. No one's telling us to promote this person over that person or compensate this person over that person. That's all being decided within Lexington as it has been over the last 30 years. But with the launch of this evergreen product, what we call Flex, it's been very obvious the benefit of being a part of the Franklin family. So because Franklin does not have any businesses that compete against underlying GPs who we are supposed to work with, and you can't say the same thing about some of our competitors who are part of bigger organizations that have competing businesses. Franklin's free from that, so we're free from that conflict. Or even sellers. Some of them are owned by banks, and they're banking sellers, and they generally don't like to sell to their competitors. We're completely free from that because Franklin is not in those businesses. But what we've been able to do with the evergreen product is that we don't have to do something that we aren't used to doing, which is managing liquidity in these evergreen vehicles and hiring new people in different offices, which some of our competitors have had to do if they want to get into the evergreen business. All we had to do was we continue to do what we've been doing, which is secondary investing, and we let the experts in liquidity management and distribution to the vast distribution network that Franklin has across the world, and definitely in Australia. And we really think that's a perfect marriage between the two. So we couldn't be happier.
So John, you work in a team and specialize in private equity secondaries. For advisors, wealth professionals that are watching this, that are currently using fund of funds or other structures, maybe they're in listed markets or maybe they go direct. What does secondaries offer at Lexington Partners that you think's compelling for the market to understand?
I think first of all, there's public markets and private markets. And public markets, I think most people are familiar with and most people have access to. And having been a private market guy my entire career, I think I'm a little bit biased, but I think private markets offer the level of stability and the reason why I prefer the private market is because these assets are not marked to market every day. And knowing me, I won't be able to deal with these day-to-day fluctuations, whereas private markets in general are a lot more stable because these are quarterly valuations. So that's one part of it. The other part of it is it's just it's ever-growing part of the markets that most people don't have access to. That's private equity. Now, private equity has a lot of benefits, but there are a few downsides to private equity. I think, just to name a few, blind pool risk, because you're essentially, you mentioned a primary fund of funds, you're essentially trusting the GP, the primary fund of fund GP, to select the right managers who will then select the assets that they choose to invest into. So from an investor's perspective, you don't have visibility towards that. You're just going off of the track record of the GP. So that's why we call it blind pool risk. There's blind pool risk. There's a J-curve effect, because in the beginning, for a company to be valued up, it takes time, but you still have to pay fees and expenses to that manager to do that. So initially, your net returns are negative. And then thirdly, depending on the strategy that you invest in, let's say if you invest in venture, the possibility of outcomes can be quite broad, right? Because you're starting from year zero. Now, all of that can be resolved through the secondary strategy because we're buying at around year 4 or 5 of that fund's establishment. So you're investing in a portfolio that you can look at and buy. So your blind pool risk is reduced. J-curve, you're investing after the J-curve is passed, so you don't have any J-curve issues. And then also the possibility of outcomes by year 4 or 5, even in a venture portfolio, you see the outperformers and the underperformers. So your risk is a lot less. So I think those are the big benefits of secondaries. The other benefits is if you try to invest in private equity as a primary investor, it'll take you a very long time to build a balanced portfolio of different funds, different strategies, different geographies, and different managers. It's a very laborious, time-consuming exercise, whereas in secondaries, the beauty of it is you can buy back catalogs of funds. So you can buy, in 2025, you can buy 2020 2015 vintage funds, 2017 vintage funds, and you can buy 100 fund interest in one fell swoop from one buyer. So in a given deal, just one deal, you can get diversification into 50 different GPs and over 1,000 companies across the entire world. And by the way, you can buy these things usually at a discount. So all of that put together basically allows you to access private markets in a diversified, cushioned way from discounts and diversification. And you get to mitigate a lot of the downsides that you have in investing on a primary basis into private equity.
Felicity, have Australian investors been traditionally allocating to private equity secondaries? I know for 40 years Franklin Templeton's been in Australia. If you have seen it, which sort of investors are allocating?
Yes, so Australian investors, particularly the superannuation funds, have been very heavy investors in private markets for many, many years. In fact, they're some of the largest allocators to a variety of private markets, infrastructure, real estate, private equity. So yes, many of the superannuation funds have large private markets programs, and private equity is a large component of that. And many of those clients will also have an allocation to secondaries. So that will be a component within their portfolio. And I think there's a lot of reasons why those clients seek out secondaries. There's obviously some differences between traditional private equity primaries, such as you're entering into a portfolio after the investment period, so you're coming in post J-curve, so you're not having to withstand that uncertainty in those early years of long-term primary private equity funds. And that's very attractive. And of course, there's look-through, there's big investment teams looking at these portfolios, and they're able to have look-through into the deals. So they're really able to get a good feel for the managers managing and their success. Another point is investors will see secondaries as kind of a completion to their programs. So maybe they've had to divest some of their program to deal with liquidity, and then they're wanting to reinvest. So they can use the secondaries as a more accessible, more tailored solution to kind of fit with what they're specifically looking for, whether it's a particular vintage or a particular sector or some specific exposure that they're looking for to round out their private market allocation. I think the other key thing obviously is around alpha generation. So they're looking for really strong returns. And again, with secondaries, there's just there's that element of having line of sight into which companies are actually being invested in. So you can really rate the secondaries managers as to how successful they really are at dissecting these portfolios and determining which of the companies are really going to generate strong returns. So I think that certainty around the alpha generation's also been very attractive as they've looked to seek high returns. We've also seen family office investors in private equity secondaries for a number of years in Australia. And again, that's kind of off the back of what we've seen institutional investors, the direction that they've moved in. So there's obviously family offices have got, they're looking for those higher returning strategies. And they think in the way that institutional investors think, with a slightly longer term mindset often. And they're trying to seek out really unique opportunities. So I think it suited that market really well. And increasingly, we're then obviously seeing the wealth space more interested. And one of the dynamics we've seen here is the investment professionals moving across from the institutions into the wealth market, and they've had access and seen what they can achieve from private equity secondary investments, and then they're coming across to the wealth side and saying, well, we want to allow our clients to have that access. So I think we're really seeing that journey tick up now.
John, could you capture some of the trends that you're seeing in private equity secondaries and how your fund is positioned to access them?
There's a secular trend of secondary deal volume increasing quite exponentially, and it's actually driven by two factors. Number one, there's an increased inventory of private equity assets that have been built up in the system in the form of primary fundraising in private equity. That's been at an all-time high for a long while now. That's one part. So the inventory is increasing. The other part of the formula is the turnover rate. So that's the propensity at which LPs are selling their private equity interests into the secondary market. Now, that has also been increasing if you look at the historical data. So if you have increasing inventory and increasing turnover, what happens is the picture that we see, which is exponentially increasing secondary market. So that's really the main driver of why some clients ask us, hey, okay, well, it's a record year of deal volume secondaries. What's going to happen next year? Well, I can't guarantee that it's going to continue to go up in a straight line, but the secular trend, the direction is always going to be going up because of those reasons. But in addition to that, what we're seeing these days is ever since early 2022, there has been a reduced liquidity coming out of private equity. And this is driving LPs who have been used to just holding on to these assets that liquidate themselves to think of ways to sell this actively into the secondary market. So that is actually providing a further boost into the market. And I can confidently say I've been with the firm for 11 years, which actually brings the average tenure of the firm down because our partners have been around for so long. But even in my 11 years, this is the biggest market opportunity that we've ever seen. And most of my partners who've been with the firm for a longer period of time, they would say the same thing. So we're very excited about that opportunity. But the truth is, this market is undercapitalized. So from our perspective, we have one of the largest ever secondary funds raised in our closed-ended fund. But the additional capital that we're raising through our evergreen funds is frankly not enough to tap this market. So it is a very interesting and favorable dynamic for secondary investors.
For advisors watching this in the Australian market, they have seen some new products and structures come on stream. You were with the founding team, pioneers of the secondary space. How would you say Lexington Partners stands out in this market?
We have a lot of respect for our competitors. The market is full of very experienced secondary players, and the market's big enough for all of us to compete in. Now, there's several things that differentiates us. You just mentioned that we're a pioneer of this industry, but frankly, when it comes to evergreen vehicles, we are not the pioneers. We're actually a bit of a late starter. And I think that there's a lot of benefits to that because we've seen some of our competitors and non-competitors within the same private equity industry bring out their evergreen vehicles. Some have had some hurdles and things like that. So I think there are certain lessons that we learned from that. So I think it's actually good that we are not a pioneer of the evergreen strategy. A few things that differentiates us. Number one, we have the same IC that makes the decision on the deals that we do. I know that certain other evergreen funds have a separate IC that makes different decisions, which we didn't want to have. We didn't want our investment committee to have some sort of a conflict in terms of where to allocate certain deals. So we have one IC making the decision on deals, which then get allocated to the different vehicles. Our carried interest, which is our incentive, are the same between the closed-ended vehicle and our open-ended evergreen vehicle. So again, that also reduces any conflict of interest in decision-making. And these were very well thought out, deliberate decisions that we made so that there's no conflict of interest. And again, from what I know, that's not always the case in the market. The other factor is if you look at a lot of evergreen funds that are out in the market, secondaries is only a small portion of their portfolio. There's more co-investments. Some of them have other products that the GP has in their stable in there. Lexington and Franklin's evergreen product is differentiated by the fact that our main focus is the secondary strategy. And we believe that we are quite unique in that market in that respect.